Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's May 27th, 2013. The market's 4-week winning streak finally came to an end last week, although the Dow Jones average did manage to extend another record-breaking streak, as it's now gone 101 days in a row without a 3-day pullback, for the first time in its history. I do believe that the long-awaited spring correction has begun, but I don't believe that that fact will be widely accepted right away. So far, the S&P 500 index has only lost about 2% from its intraday high Wednesday morning to the close on Friday. While the nastier sort of correction does start with a steep fall, more typically a correction begins with just a bit of a wobble. In the absence of a big plunge or some other sign of panic, one usually sees lots of dip buying at the outset, along with attempts to rally the tape. It'll be 2 steps backward, 1 step forward, that sort of thing. Most of the price damage in a typical correction comes near the very end, when more money finally starts to get scared. So while the parabola may be gone, there is still quite a bit of complacency, perhaps brought on by buying lots of index call options just before the market started to fade. Once one makes a big bet, there's usually a tendency to refuse to believe it might not come true. Another reason why the heavy selling tends to come towards the end, when people bail out on the market just in case the single-digit drop turns into double digits. Fed talk of easing back on the throttle ignited much of the recent selling, as you probably noticed last week, and it was pushed along further by Chinese data that revived fears of a global slowdown. But a slowdown is not widely accepted yet, so the market will remain highly sensitive to data in the coming weeks. Europe had a good-sized rally on Memorial Day, perhaps in anticipation of the US being up 20 Tuesdays in a row, so the silliness is by no means gone. The next really big report doesn't come until the Friday after this, with the May jobs report. That report could very easily be the inflection point for a move deeper down or another reversal. How the Fed might respond to it could complicate matters. It's not out of the question that a robust jobs report, which I don't expect, but with seasonal adjustments one never knows, could sink a market, fearing that a Fed pullback is now sooner rather than later. Technically speaking, the market is no longer at extreme levels on a short-term basis. However, it is still quite extended both the intermediate and the longer term, so I would think twice about being bold on this dip. It might be safer to wait it out for a few weeks and do what the Fed says it's doing, waiting to see what the data says. But in the meantime, the series of global currency skirmishes is threatening to warm up into a real war. The latest rate cuts are not about liquidity. They're about competitive evaluation. It could get ugly, and the forward-looking stock market might wake up to that quite late. If you're wondering how dumb the herd can get, the answer is pretty dumb. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.